Something extraordinary just happened in the gold market that has institutional traders scrambling. And I'm not talking about another all-time high. I'm talking about a specific technical level that historically signals one thing: panic buying is about to accelerate. Let me show you exactly what I'm seeing, because the implications for your wealth over the next 12 months are massive. Gold just crossed above $4,300 per ounce. Now, you might be thinking, okay, another record high. What's the big deal? But here's what most people are missing. This isn't just any price level. This is what professional traders call a safety flight threshold. It's the point where institutional money stops asking, should we buy gold? And starts asking, how much can we get our hands on before everyone else figures this out? Let me explain what's really happening behind the scenes, because the mainstream financial media is completely missing the story. When gold breaks through certain psychological barriers, it triggers algorithmic buying programs. These are automated systems that manage hundreds of billions of dollars. They're programmed to recognize specific patterns, and one of those patterns is accelerating momentum through round number resistance levels. We just saw gold blast through $4,000, consolidate briefly, then surge past $4,300. That's a 7.5% move in a matter of weeks while the dollar is strengthening. That should be impossible according to traditional market relationships, but it's happening. And the reason why reveals something deeply concerning about the global financial system. Central banks are in full accumulation mode, not the cautious, measured buying we saw in previous years. I'm talking about aggressive, almost desperate purchasing. The World Gold Council's latest data shows central bank gold purchases running at levels we haven't seen since the 1960s. Think about that time frame for a moment. The 1960s. That was right before the Bretton Woods system collapsed. That was right before Nixon closed the gold window in 1971 and ended the dollar's convertibility to gold. History doesn't repeat, but it sure does rhyme. Let me give you some specific numbers, because this is where it gets really interesting. China's central bank just resumed gold purchases after a 6-month pause. They're not buying 10 tons here and there anymore. They're buying in bulk. And they're not alone. Poland, Singapore, India, Turkey, the Czech Republic. These aren't small players. These are sophisticated central banks with access to the best economic intelligence in the world. And they're all doing the same thing at the same time. Now, why would central banks be panic buying gold right now? They have access to information we don't. They see the currency flows. They see the debt levels. They see the geopolitical tensions brewing. And they're making a calculated decision that physical gold is more valuable than holding dollars or euros or yen in their reserves. Let me tell you a story that perfectly illustrates what's happening. Back in 2008, right before the financial crisis hit its peak, there was a small group of hedge fund managers who saw something strange in the credit default swap market. The prices were moving in ways that didn't make sense unless something catastrophic was about to happen. They couldn't prove it. They couldn't point to a specific event. But the market was screaming that danger was coming. Those who listened and positioned themselves accordingly made fortunes. Those who ignored the signals lost everything. We're seeing similar signals right now in the gold market. The price action is telling us something that the official economic data isn't showing yet. It's like watching smoke before you see the fire. Here's another piece of the puzzle that's absolutely critical. The gold to silver ratio just did something fascinating. For those unfamiliar, this ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio gets extreme, it signals major market dislocations. Right now, we're seeing silver surge even faster than gold. Silver has more than doubled recently. That's not normal. That's not a gradual bull market. That's panic buying spreading from gold into silver as investors realize they might have missed the early move in gold and are looking for leverage. When you see both metals moving in tandem like this, with silver actually outperforming, it tells you something important. This isn't just about gold as a safe haven. This is about a fundamental loss of confidence in paper currencies, because silver is more of an industrial metal, more of a monetary metal for smaller transactions. When silver starts moving like this, it means the smart money is preparing for a scenario where precious metals become essential, not optional. Now, let me show you what's happening in the physical market, because this is where things get really interesting. There's a massive disconnect between paper gold and physical gold right now. The COMEX, which is the major futures exchange for gold trading, is showing signs of stress. Open interest is declining while prices are rising. That's unusual. Normally, rising prices attract more speculative interest, which increases open interest. But we're seeing the opposite. Why? Because the big players are closing out paper positions and taking physical delivery. The LBMA in London, which is the other major gold trading hub, is seeing similar dynamics. Lease rates are spiking. That means it's getting more expensive to borrow gold. Why would lease rates spike if there's plenty of gold available? They wouldn't. Lease rates spike when physical gold is tight, when people who have gold don't want to lend it out because they think they might need it. Let me paint you a picture of what this looks like on the ground. Imagine you're a bullion dealer in New York or London or Zurich. 6 months ago, if a client wanted to buy 100 ounces of gold, you could have it delivered in a few days. Today, that same order might take weeks. The premiums over spot price have widened. The spreads between bid and ask have expanded. These are all signs of a market under stress, a market where physical metal is becoming harder to source. And here's the kicker. While all this is happening, gold ETF holdings are actually increasing again after a period of outflows. That means retail investors and institutions are coming back into the market. They're buying paper gold through ETFs, which creates additional demand for physical gold that the ETFs need to hold to back their shares. This creates a feedback loop. More ETF buying means more physical demand, means tighter physical markets, means higher prices, means more ETF buying. You see where this is going? Now, I want to talk about something that most analysts are completely ignoring: the geopolitical dimension of what's happening. We're watching the early stages of a global monetary reset, whether people want to admit it or not. The BRICS nations, Brazil, Russia, India, China, South Africa, plus dozens of other countries that have joined or are applying to join, they're actively working on alternatives to the dollar-based system. They're settling trade in local currencies. They're building payment systems that bypass SWIFT. And they're accumulating gold as the foundation for whatever comes next. This isn't conspiracy theory. This is official policy. These countries have openly stated their intentions. They've held summits. They've signed agreements. They're building the infrastructure right now. And gold is at the center of it all because gold is the one asset that every country recognizes as valuable, regardless of political differences or economic systems. Think about what that means for gold prices. If even a fraction of global trade starts settling outside the dollar system, and if gold becomes the bridge asset between different currency zones, the demand for physical gold will be unlike anything we've seen in modern history. We're not talking about a 20% or 30% move higher. We're talking about a fundamental repricing of gold relative to fiat currencies. Let me give you a historical parallel that might help frame this. In 1971, when Nixon closed the gold window, gold was $35 per ounce. By 1980, it had reached $850. That's a 24-fold increase in less than a decade. Now, I'm not predicting that exact scenario will repeat, but I am saying that when the monetary system undergoes fundamental change, gold reprices dramatically. And we're in the early stages of fundamental change right now. Here's something else that's crucial to understand. The debt situation globally is completely unsustainable. The United States alone has over $36 trillion in federal debt. That number is growing by trillions every year. Europe is drowning in debt. Japan's debt to GDP ratio is over 260%. China has hidden debt in local governments and state-owned enterprises that nobody can accurately measure. This debt can never be repaid in real terms. It can only be inflated away or defaulted on. Either scenario is catastrophic for currency holders and beneficial for gold holders. When governments are trapped by debt, they have limited options. They can raise taxes, which is politically difficult and economically destructive. They can cut spending, which is politically impossible in most democracies. Or they can inflate, which is the path of least resistance. They print more money. They keep interest rates artificially low. They monetize the debt through central bank purchases. And when they do that, the purchasing power of the currency declines, and hard assets like gold preserve wealth. We're already seeing this play out. Real interest rates, that's the nominal interest rate minus inflation, are negative or barely positive in most developed countries. When real rates are negative, you're losing purchasing power by holding cash or bonds. Gold becomes the logical alternative because it has no counterparty risk, it can't be printed, and it has maintained its purchasing power for thousands of years. Now, let me address something important for anyone sitting on significant retirement savings. If you have $100,000 or more in traditional retirement accounts, IRAs, 401ks, you need to understand how gold IRAs work. I put together a comprehensive guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. It's in the description below. It walks through the process step by step, explains the rules, shows you what to watch out for. If protecting your retirement savings is a priority, it's worth taking a look at. All right, back to where this market is headed next, because the technical picture is setting up for something significant. When you look at the gold chart, what you're seeing is a classic breakout pattern. We had a long consolidation phase where gold was building energy, coiling like a spring. Then we got the breakout above $4,000, which was the first major signal. Now we're seeing follow-through momentum above $4,300. The next major resistance level is around $4,500, and if we break through that with conviction, there's not much standing in the way of $5,000. But here's what's really interesting from a technical perspective. The moving averages are all aligned bullishly. The 50-day moving average is above the 200-day moving average, which is called a golden cross. The price is above both moving averages, showing strong momentum. The RSI, which measures whether an asset is overbought or oversold, is elevated but not at extreme levels yet. That suggests there's still room to run before we hit a short-term top. Volume patterns are also confirming the move. We're seeing increasing volume on up days and decreasing volume on down days. That's exactly what you want to see in a healthy uptrend. It means buyers are in control, sellers are stepping aside, and the path of least resistance is higher. Now, let me talk about what could derail this move, because it's important to understand the risks. The biggest threat to gold in the short term would be a sudden spike in real interest rates. If the Federal Reserve were to dramatically raise rates and bring inflation down quickly, that would make bonds more attractive relative to gold. But here's the problem with that scenario. The government can't afford higher rates. The interest expense on the national debt is already consuming a massive portion of the federal budget. If rates went significantly higher, the interest payments would become unsustainable. So the Fed is trapped. They can't raise rates enough to truly combat inflation without breaking the government's finances. The other risk would be a deflationary collapse, a scenario where economic activity grinds to a halt and asset prices crash across the board. In that scenario, cash becomes king temporarily, and even gold can decline in nominal terms. But here's the thing about deflationary collapses. They're incredibly rare in fiat currency systems, and when they do occur, governments respond with massive monetary stimulus, which ultimately benefits gold. So even in a deflationary scenario, gold is likely to outperform most other assets over a full cycle. Let me tell you another story that illustrates the power of gold during crisis periods. In 2008, during the depths of the financial crisis, gold initially declined along with everything else as investors scrambled for cash. Gold dropped from around $1,000 to $700 in a matter of months. People who didn't understand the bigger picture panicked and sold. But those who held on or bought more during that dip were rewarded handsomely. By 2011, gold had surged to $1,900, nearly tripling from the crisis lows. The people who understood that the government's response to the crisis, the money printing, the bailouts, the zero interest rates, would ultimately be inflationary for hard assets, those people positioned themselves correctly and profited enormously. We're in a similar setup today, except the imbalances are larger, the debt is higher, and the geopolitical tensions are more severe. The response to the next crisis, whenever it comes, will be even more extreme than 2008, and gold will benefit even more dramatically. Here's something that doesn't get talked about enough. The mining supply of gold is actually declining. It's getting harder and more expensive to find and extract gold from the earth. The easy deposits have been mined. The remaining deposits are deeper, lower grade, in more remote locations. This means the cost of production is rising, which puts a floor under gold prices. If gold were to drop below the all-in sustaining cost for most miners, which is somewhere around $300 to $500 per ounce, mines would shut down, supply would contract further, and prices would rebound. So there's a natural support level built into the market based on production economics. At the same time, demand is increasing from multiple sources. Central banks are buying. Asian consumers, particularly in China and India, are buying. Investors are buying. Industrial users need gold for electronics and other applications. This combination of declining supply and increasing demand creates a fundamental imbalance that can only be resolved through higher prices. Now, let me address the elephant in the room. Some people look at gold at $4,300 and think, "I've missed it. It's too expensive now." That's the wrong way to think about it. Gold isn't expensive or cheap in absolute terms. It's only expensive or cheap relative to other assets and relative to the amount of currency in the system. When you adjust gold for the expansion of the money supply, when you look at gold relative to the total amount of dollars or euros or yen in existence, gold is actually not expensive at all. In fact, by some measures, it's still undervalued compared to historical norms. Here's a simple way to think about it. In 1980, when gold hit its previous inflation-adjusted peak, you could buy the Dow Jones Industrial Average with about 1 ounce of gold. The Dow-to-gold ratio was 1.1. Today, even with gold at $4,300, the Dow is around 42,000. That's a ratio of roughly 10.1. If we were to return to the 1980 ratio, either the Dow would need to crash to 4,300 or gold would need to rise to $42,000, or some combination of both. Now, I'm not predicting gold at $42,000 tomorrow, but I am saying that relative to other assets, gold has significant room to appreciate. Let me give you another comparison. The total value of all the gold ever mined is roughly $15 trillion at current prices. That sounds like a lot until you compare it to other asset classes. The total value of global real estate is over $300 trillion. The total value of global stocks is around $100 trillion. The total value of global bonds is over $130 trillion. Gold represents a tiny fraction of global wealth. If even a small percentage of capital flows from these other asset classes into gold, the price impact would be enormous. And that's exactly what we're starting to see. Institutional investors who previously ignored gold or allocated 1% or 2% of their portfolios to gold are now increasing those allocations to 5% or 10%. Sovereign wealth funds are doing the same. Family offices are doing the same. This is a slow-moving tsunami of capital that's just beginning to build. Here's what keeps me up at night, and what should concern anyone paying attention. The financial system is more fragile than it appears. We've had over a decade of artificially low interest rates, massive money printing, and government intervention in markets. This has created distortions and imbalances that will eventually need to be corrected. When that correction comes, and it will come, the assets that perform best will be those with no counterparty risk, those that can't be printed or manipulated, those that have intrinsic value. Gold checks all those boxes. Think about what happened with the banking crisis we saw recently. Multiple banks failed in a matter of days. Depositors panicked. The government had to step in with emergency measures. And what happened to gold during that period? It surged. Because when confidence in the banking system wavers, people look for alternatives. They look for assets they can hold outside the banking system. Assets that don't depend on someone else's promise to pay. This is the core value proposition of gold. It's not about getting rich quick. It's about preserving wealth through periods of monetary chaos and financial instability. It's about having an asset that will still have value when other assets are in question. It's about insurance against the unthinkable becoming reality. Now, let me talk about the silver market for a moment, because what's happening there is equally important. Silver has been called the poor man's gold, but that's actually selling it short. Silver has unique properties that make it incredibly valuable. It's the most conductive metal, which makes it essential for electronics, solar panels, electric vehicles, and countless industrial applications. At the same time, it's a monetary metal with thousands of years of history as currency. This dual nature gives silver explosive potential. The silver market is much smaller than the gold market. Total annual silver production is only about $30 billion worth of metal. That's tiny compared to gold's $200 billion annual production. This means silver is more volatile, more prone to explosive moves when demand surges. And we're seeing demand surge right now. Industrial demand is growing as the world electrifies. Investment demand is growing as people realize silver is undervalued relative to gold. The gold-to-silver ratio, which historically averaged around 15:1 or 20:1, is still elevated even after silver's recent surge. If that ratio returns to historical norms, silver has massive upside potential. But here's the really interesting part about silver. There's evidence of a supply squeeze developing. Silver inventories at the COMEX have been declining. Premiums for physical silver coins and bars have been elevated for months. Delivery times have extended. These are all signs that the physical market is tighter than the paper market suggests. And when you have a tight physical market combined with growing demand, you get price explosions. Let me tell you about what happened in 2011. Silver went from $18 per ounce to $49 per ounce in less than a year. That's a 172% gain in a matter of months. What drove that move? A combination of investment demand, industrial demand, and a short squeeze as traders who had bet against silver were forced to cover their positions. We're seeing similar dynamics setting up today, except the fundamental backdrop is even more bullish. Here's something most people don't realize. The amount of silver available for investment is actually declining over time. Unlike gold, which is mostly recycled and accumulated, silver gets consumed in industrial applications. It's used in tiny amounts in electronics, solar panels, medical devices, and other products where it's not economically viable to recover it. This means the above-ground supply of silver available for investment is shrinking even as demand is growing. That's a recipe for a supply crisis. Now let's talk about what this all means for your personal financial situation. If you're holding significant wealth in cash or bonds, you're losing purchasing power every day. Inflation is running higher than official statistics suggest. The CPI doesn't capture the real increase in the cost of living that most people experience. Food prices are up dramatically. Energy prices are volatile but trending higher. Housing costs are through the roof. Your dollars are buying less and less. Gold and silver offer a way to preserve your purchasing power. They're not going to make you rich overnight. They're not going to double in a week. But over time, over years and decades, they maintain their value in real terms. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same about dollars? About any fiat currency? The strategy here isn't complicated. You allocate a portion of your wealth to physical precious metals, not all of it. You still need liquidity for daily expenses. You still need diversification across different asset classes, but a meaningful allocation to gold and silver, somewhere between 10% and 30% depending on your risk tolerance and outlook, provides insurance against monetary instability and potential upside if the scenarios I've outlined play out. And here's the critical part. You want physical metal, not just paper claims on metal. ETFs have their place for trading and liquidity, but if you're buying for wealth preservation, for insurance against systemic risk, you want metal you can hold, metal that's outside the banking system, metal that doesn't depend on any institution's solvency. Coins, bars, stored in a safe or a private vault, that's real wealth preservation. Let me give you one final thought to consider. Throughout history, every fiat currency has eventually failed. Every single one. The average lifespan of a fiat currency is around 27 years. The dollar has been a pure fiat currency since 1971, over 50 years now. That doesn't mean it's going to collapse tomorrow, but it does mean we're in uncharted territory. We're running an experiment with no historical precedent for success. And the smart money, the central banks, the billionaires, the family offices that have preserved wealth across generations, they're all buying gold as insurance against that experiment failing. The panic button level we've hit isn't just a technical signal. It's a warning sign. It's the market telling us that something fundamental is changing in the global financial system. The question isn't whether you should pay attention. The question is whether you're going to position yourself accordingly before the crowd figures it out. Because here's the thing about safety flights into gold. They start slowly, with the smart money moving first. Then they accelerate as more people recognize what's happening. And by the time it's obvious to everyone, by the time it's on the front page of every newspaper, the big move has already happened. The people who profit are the ones who see the signals early and act while everyone else is still debating whether it's real. We're at that early stage right now. The signals are flashing. The smart money is moving. The question is, what are you going to do about it?